JJ, the CPA here. Hope you're doing well. I want to walk through with you how I set up my clients for those that are going to get into real estate, whether commercial, residential, or they're flipping their properties. And this is a structure that we put together. And I want to share it with you, not only from the legal structure, but the tax structure. And so with that, I'm going to pull this up for you so that you can see exactly what it is that I'm talking about. And I'm going to walk you through this. Now with this is the full structure. And so if you do want to check out the video where I go through kind of all the structure that I put together for clients, any kind of business, then I'm going to have a link at the end of this video that will be at the bottom left, and you'll be able to see how did we get to here. But I want to focus in on the real estate. Now, what I'm going to be going through is this. So I'm going to now go through this each step. This is the end result of what we look at. I am going to purposely spend a little more time talking through this with you. And so if you don't want to listen to this longer video, well, I hate for you to do it, but you can skip to basically the end, and you're going to then see a link to the short version of this real estate video, which would be at your top left. I think it'll be obvious to you. Now, hopefully you'll just tune in, but I'm going to purposely walk you through this now step by step. I'm going to take my time. I'm going to talk to you like I'm talking to my client. So again, want the quicker version? No problem. Go and check that out. So what are we talking about here? We're talking about the individual, right? The Form 1040. And this is where all of the tax is paid. Because as I talked in the previous video related to that overall structure with S Corp and partnership and whatnot, an S Corp and a partnership, there's no tax at that level. The net income from these businesses flow down to the individual level. Now I have a playlist I'll give you a link to at the end. It'll be in the bottom right. That'll be for those that are self-employed and talk about S Corp and self-employment taxes and all that. But what we're focusing in on here is we're going to be focusing in on the real estate aspect of what is going on here. So we all start with, we've got the individual. Then what we do is we have the individual own an LLC, and it's going to be taxed as a partnership. As a reminder, an LLC is what you set up at the Secretary of State, but it doesn't dictate how you are taxed in any way, shape, or form. You decide that only with the IRS. So when you set up an LLC, in fact, it could be an S Corp, a partnership, a C Corp. It could even be filing Schedule C or Schedule E or Schedule F. So what I'm telling you is that anytime I have a client and they're starting a business, it will always be an LLC. But now when we're talking about real estate, I'm going to always have my clients in the LLC, but then taxed as a partnership. Why? Because this is going to be a passive activity, which means it won't be subject to self-employment tax. And with the partnership, we have the benefit of getting a share of liabilities for any debt that the partner signs off on, personally guarantees, or co-signs on. And by that being the case, many times in real estate, there's more loans involved. Well, that gives that owner of the partnership what's called at-risk basis. So then they will be able to deduct losses to the extent of whatever money they put in, of course, minus any distributions, plus any income that's been allocated to them that they've had to pay tax on, minus any losses that they've been allocated that reduce their basis. But we look at what the partner capital account is. That's the tax basis. But if somebody has losses, and we're talking about in a partnership, because this is not the case in an S Corp. But when we're talking about a partnership, if they don't have enough tax basis to take the losses, then you can have this at-risk basis. The at-risk basis would be the share of liabilities that are inside the LLC that partner signed off on, co-signed. They're responsible for. Now, there's some caveats to that. You're going to need to get with a tax pro to ensure that the share of liabilities is properly allocated. But see, the share of liabilities inside the LLC tax as a partnership, that is not available with an S corporation. The only way to have what's called at-risk basis with an S corporation is to actually loan money to the S corporation. So again, why do we want an LLC tax as a partnership when we get into real estate. Won't be subject to self-employment tax. And we now have the added benefit of potentially having what's called that at-risk basis, which then allows the owner, that individual, to be able to potentially deduct the losses if they're limited with their tax basis. Now, what we look at here, though, is that we would have our clients set up a sub LLC. Now, hold on. We're talking about, setting up a second LLC. It would be the sub of the master LLC. So if somebody's looking to buy a property, we would say, well, let's set up that property in another LLC. Now, I don't work with clients that are going to worry about paying $100 or so to the Secretary of State to just set up another LLC. Now, just hold on. Don't get ahead of yourself here. Okay. Just hold on. Okay. We're setting up a separate LLC because we want to shield the liability inside this sub LLC. We want to shield any liability of property one from anything else outside of that sub LLC. That's going to shield any liability, provide protection from what's going on in the master LLC, as well as then any other activities. So when we're talking about setting up that separate LLC, we're going to have it be classified as a disregarded entity for tax purposes. So all that means is that a disregarded entity doesn't file a separate tax return. So just pause for a second, right? Because I know your mind may be going a lot of different directions. All I want you to know is that we're talking about there's still a legal entity. You still get an EIN. That sub LLC owns property one. So property one's going to be titled in that LLC. When we say it's disregarded, all we're saying is that it doesn't file a separate tax return. So when you go to the bank, that LLC is a legal entity. That is, if you qualify, going to be able to get the loan. It will be able to own that property. It will be able to have a separate bank account. It can walk and talk in any manner that we're talking about when we think of a separate business from the master LLC. It's just one thing. You ready for this? I'm just repeating myself. There just isn't a separate tax return because all of the activity is then reported in the master LLC partnership. So whatever the income and the expenses and the depreciation is related to property one, that's going to get actually reported on the partnership tax return, that form 1065. Now, when they go to buy the next property, you're right. Hopefully your mind isn't blown right now. This is just what we do with clients. They would set up another sub LLC. And guess what? I didn't even create any more work for myself. In fact, I've taken away doing an additional tax return because sub LLC with property number two is also a disregarded entity. So there's no separate tax return being filed for the sub LLC number two and no separate tax return being filed for sub LLC that owns property number one. So this isn't a ploy for, oh, well, you're just creating more work for yourself. Actually, I make it easier on your tax professional because you're just going to file one tax return because, again, all of the activity, income, expenses, and depreciation of property and sub LLC number two there would be reported then on the master LLC and so on. So when they buy a third property, so you're right. I have clients, they own 40 properties and they have 41 LLCs. They have 40 sub LLCs and they have one master LLC tax as a partnership, but they file one tax return that encompasses all the activity of all of those sub LLCs. But then each one of those properties is protected from liability from any of the other properties. So for my client, them getting liability protection for a mere $100, maybe another $25 a year to file for the continuation of the LLC with the Secretary of State, at least here where I'm at, is not a big deal to them. Because again, you could run all of this activity in one bank account. This also provides a little more ease in getting a loan that can then be in the master LLC partnership, but then is used for what that master LLC partnership owns. See, the master LLC, which is owned by the individual there, well, that master LLC does own all these properties. It's just that all these properties are inside this sub LLC for the liability protection. Now, if you are getting into flipping activities and you're going to also own real estate, so the clients that I have that will buy real estate, fix it up, maybe they decide to rent it, but maybe they buy the property, they fix it up, and then they're going to sell it. So they're just flipping it. Well, what we do with that is we put that activity in a separate LLC. That's a different kind of risk going on when you're flipping a property, because you're buying it quick, you're hiring subcontractors, you're fixing it up, you're selling it to somebody. Maybe there's issues related to that. So we are protecting the properties in 1, 2, and 3. We're protecting those properties from anything that happens with the flipping activity. Now, all of that activity of flipping there in that 4th sub LLC, again, would just be then reported right there in the master LLC. So really the key here is that that master LLC is going to own each one of these 100%. And so with the IRS, when something's owned 100%, it has the option of being a disregarded entity. Now, know this. One person that owns an LLC, as a side note, could decide to be taxed as an S Corp. An LLC that's owned by one person, and some people will say, well, that's a single member LLC, can file a Schedule C, it could file a Schedule F, it could file a Schedule E. An LLC with one owner could file also a C Corp. So anybody that says, well, I'm a single member LLC, can I do this? I have to say, well, a single member LLC means you could be anything other than a partnership. Single member LLC just means it's one owner, which then again, that option is that there's not a separate tax return. So for IRS purposes only, it's a disregarded entity. Now you're right. You would need a second partner when you're talking about a partnership. So for our clients, let's just go with a simple example. Somebody's like, well, I don't have a partner. I don't want there to be a partner. I'm talking about a business partner here. And maybe they're not married, and maybe they don't have any kids, they don't have any other family, or maybe they just don't want any other family to be an owner in it. Well, you can just set up another sitting LLC. I don't have it pictured here because I don't want to overwhelm our graph here. But you can set up another little LLC that the individual owns, and that LLC would then own a fraction of a percent of the master partnership so that it has two partners. I don't really want you to get bogged down in that, because if you're dealing with a tax professional that's really familiar with these issues, they're going to know immediately either what you're talking about or how to structure that, because what I'm getting at is that a partnership does need to have two owners, but it doesn't need to have two individual owners. It just simply needs to have two owners. So when we are talking about this, any of the activity, the income, the expense, and the depreciation is all going to get reported on that one master LLC tax return, which files a partnership return. And technically, property 1, property 2, property 3, those activities would be combined and reported on Form 8825 that is with the Form 1065, because that's where rental real estate would go. Now, many could still separate out on Form 8825 each of these activities, because there's a column that could be, well, here's the column for the activity of property 1. Here's a column 2 on the Form 8825 that goes with the partnership return to reflect the activity of property number 2. So you don't even have to necessarily consolidate all the numbers. So for our clients, if they do have separate books, so they would have a separate set of financials for property 1 sub LLC, they'd have a separate set of financials for sub LLC with property 2, separate financials for sub property number 3. If we don't want to go through even adding all that together, then to combine it to report that, it would all be still reported on Form 1065 on that Form 8825, and each one of those would just get a column unto itself. Because we do have clients that they do want to track this separately to know what the income is, the expenses, the depreciation, property by property. So we don't dilute the opportunity to really know how the businesses are performing on the rental activity. Now, if you are flipping real estate, that gets reported on page 1 of the partnership return, because that's an active activity and that would be considered ordinary income. Most of the time for the clients I'm working with that are flipping, they're not really doing much. I mean, they're buying the property, they're getting the financing, but they're hiring subcontractors. They're not in there pounding the hammer and putting up the drywall and painting and rolling out the grass, if you will. So it still really can keep the manner of being passive, meaning not subject to self-employment taxes, but it would be reported, the flipping activities, on page 1. So as you can see, it's still one tax return, but you still can separate out this information, or you can just combine it all. You still would need the flipping activities on page 1 of Form 1065, and then whatever you're renting out, if you did want to combine it all, then it would go on the Form 8825. So what that does then is whatever the net income is, which really kind of flows down to one number, what's the net of your rental real estate activity? That's box 2 of a Schedule K1. And what's the net income of the flipping activity? That's box 1 of the K1. So in case I said that incorrectly, let me make sure. The flipping goes on page 1 of Form 1065, which goes in box 1 of your K1. The rental activity goes on Form 8825, and it gets reported on the Form 1065, and then down to the partner, it goes on Schedule K1, box 2. But both box 1 and 2 get reported in the same place down at the individual return, which is on Schedule E, page 2. Now, you do have to take into account, as we talked about earlier, your tax basis. You do need to take into account your at-risk basis, because if you have losses, you'll only be able to take losses to the extent of your tax basis. And again, if you're out of tax basis and then you are at risk, meaning you have that share liabilities that we talked about earlier, well, then you can take losses to that extent. Now, for those that are really astute and they're just tuning in, yes, when you use at-risk losses as your liability becomes less and less over time because the loans get paid off, you got to be mindful of that, because there could be some recapture of losses if later it's not showing income. Also, when you're talking about the share liabilities, you want to be sure that you actually are at risk. So you need to be careful to make sure that if you're really saying you're part of that liability in that loan, that you really are, that it's all documented that way. So no structure is perfect, but this is the structure that I've been working with my clients with for literally the last 25 years. I've worked in the business of doing taxes, still am, and in the trenches for the last 30 years. And at about year 5 of when I started my practice, this is something that we put together and we do with all of my clients. And this seems to work really well. It simplifies things. It allows for there to be liability protection. And then it puts us in a position where we can simplify the reporting. Things can be combined. Still have to be mindful of passive and active activities, because if you are somebody that you're flipping the property and you are getting the hammer out and the paintbrush and doing all that stuff, which is super handy, well, then you might be considered non-passive. But see, the benefit here is even with the one partnership return is that Form 8825 that would encompass the activity of property 1, 2, and 3, those sub LLCs. That's going to be passive. Now, if you're a real estate professional, of course, there are exceptions. There's only so long we want to make this video. But we do know if you're a real estate professional, you have over the 750 hours, meet those qualifications, then potentially that net income on Form 8825 could be considered non-passive. It still would not be subject to self-employment tax. But if you're actively involved, as I said, swinging the hammer, painting the brush, rolling out the carpet as well as the grass, and doing the flipping, well, then that gets reported on page 1 of the 1065, as I indicated. But that potentially could be subject to self-employment tax, because once you're materially participating, even though it's a partnership, that activity could be subject to self-employment tax. But see, my point is that it's been broken out. Now, I would just say as a side note, if somebody then rises to the level where they are swinging the hammer, right, using the paintbrush, rolling out the carpet and the grass in the front yard, I probably would tell them to actually have their flipping activities inside an S Corp. Why? Well, because the net income from an S Corp is not subject to the self-employment tax. But again, I'm going to give you a link in the body of this video related to kind of that overall structure. But for my clients, most of them, when they get into real estate of owning it, either commercial or residential or both, they also get into the flipping, and they're not actively involved with that. And that's where this structure really comes into play. Now, if you skipped all the way to the end, you missed a lot. But if you want to see the shorter version of this real estate video, then you're going to find that right there. And if you want to see then the structure video, where I just kind of talk in general about how we structure our clients for S Corp and partnership, that video will be there. Love it if you'd subscribe. And then right down here, I'll have a number of videos for those that are self-employed, S Corp owners. So I'll give you a link to a playlist. So with that being said, thanks for tuning in. I'd love it if you'd subscribe. And then don't you ever forget, you've never met a CPA quite like me. All right, you have a great one. Appreciate you. And thanks for tuning in all the way to here. All right, so short real estate, got the structure in general, subscribe, and for business owners and self-employed. All right, have a great one.